One day, Wall Street fined Google 7% for spending too much on artificial intelligence. The very next day, it made Intel rich. Same boom, opposite verdicts. And almost everyone is reading it as the artificial intelligence bubble finally cracking. I think they've got it exactly backwards. Stay with me. Okay, the setup. For months, the entire market has been terrified of one thing. The giant technology companies are spending an absolutely historic amount of money building artificial intelligence, data centers, chips, power plants. And investors kept asking the same nervous question: what if all this spending never pays off? This week, the first verdicts came in. On Thursday, Alphabet, Google's parent, walked in and raised its spending plan yet again, up to $205 billion this year. And the market's reaction was brutal. The stock dropped 7%. Not because the quarter was bad. The quarter was great. It dropped because Alphabet dared to spend even more. And the bubble callers pounced. All week they've been waiting for this. A giant spending on artificial intelligence and getting punished for it. Finally, they said, the proof. The spending emperor has no clothes. The whole technology sector sold off. The victory lap started. If you only watched Thursday, you'd think the entire artificial intelligence story was unraveling in real time. The most expensive corporate buildout in history, and the market had finally called its bluff. Except the market wasn't done talking. And what it said next, 24 hours later, blew the whole narrative apart. Then, Friday morning, Intel reported. Intel doesn't design the flashy artificial intelligence models. Intel makes the chips. It is a supplier. One of the companies that gets paid when everybody else spends. And what Intel just reported stopped the bubble narrative cold. Revenue up 25%. That is Intel's fastest growth since 2011. 15 years. And the part of the business that sells directly into the artificial intelligence buildout, the data center and artificial intelligence unit, grew 59%. Profits doubled what analysts expected, and management guided next quarter even higher. The stock jumped 12 to 13%. So think about what just happened in the span of one day. The company writing the checks got fined. The company cashing them got a standing ovation. That is not a bubble popping. That is something much more interesting. Here's the mechanism, in plain English. When Alphabet spends $45 billion in a quarter building data centers, that money comes straight out of its free cash flow, the cash it could have handed back to shareholders. So when it spends more, its own stock looks less generous, even while the business booms. That is why the funders get marked down. But every single one of those dollars goes somewhere. It lands at a chip maker like Intel as an order, at a memory company as a contract, at a power developer as a 20-year deal. The exact spending that shrinks Alphabet's cash pile shows up as revenue and profit on the supplier's books. So the market didn't decide artificial intelligence is fake. It decided who it wants to own. Not the companies paying for the boom, the companies getting paid by it. And this is where the asymmetry lives. For 2 years, the easy money was in the giants doing the spending because their stocks are famous and everybody owns them. But those same giants have now become the place the market takes its money out when it gets nervous about cash flow. Meanwhile, the suppliers, the less glamorous companies actually selling the picks and shovels, are the ones printing the growth. Intel just proved it with the loudest number on the tape. When the funders get fined and the suppliers get paid, the smart question stops being, is artificial intelligence real, and becomes, who exactly is collecting the check? Now let me argue against myself, because this desk grades its own work. 3 honest outs. 1. Intel is not cheap. After that pop, it trades near 94 times forward earnings, and the rally actually faded into Friday's close. A lot of good news is already in the price. 2. Rates. The 10-year Treasury yields about 4.71%. If inflation pushes yields higher, everything gets derated, suppliers included, and this whole framework drowns in the tide. And 3. The history rhyme cuts both ways. In the telecom buildout at the turn of the century, demand was also real. Traffic really did grow for 20 years, and the overbuilders still got wrecked before the payoff arrived. Being right about the boom and wrong about the sequence is still being wrong. Respect that. So here's my call, on the record so you can hold me to it. If this really is a repricing of who gets paid and not a collapse of the boom, then the suppliers should keep outperforming the spenders. Specifically, over the next several weeks, the chip and infrastructure names that sell into the buildout hold up better than the giant hyperscalers doing the spending. Intel gave us the first data point today. If that flips, if the suppliers start falling harder than the spenders, then I'm wrong. This really was a demand scare, and I'll say so right here. That's the whole game. One clear claim and a date to check it. Here's what I'd take away. This week, the market didn't kill the artificial intelligence trade. It rewrote who wins it. The check writers got fined. The check cashers got paid. And if you were busy panicking about the bubble on Thursday, you missed the company that quietly told you the boom is very much alive on Friday. Everything else, the $100 oil, the new tariffs, the Federal Reserve next week, is in Earl's full daily brief on the channel. I'm Frankie. The asymmetric signal. One contrarian read a day. Subscribe.